In this video, I'll share Chicken Genius 2024 safest stock pick, and I'll be demonstrating it step by step on Interactive Brokers so that if you want to employ and follow Chicken Genius, you can do so and learn what he's doing at the same time. This video is only for educational and entertainment purposes only. I got this from a podcast that Chicken Genius released on Cafe Money about 4 weeks ago. Maybe I can just play a little bit of this podcast on what he feels is the safest stock to put your money on in 2024.
Because I've been shitting on this stock forever, is this stock called Alibaba.
If I'm not wrong, he bought 100k of Alibaba at $69.69. Sometimes I feel like some of these traders can actually be stand-up comedians. One of the main reasons why I decided to make this video is that I actually saw this tweet from Chicken Genius where he says the bottom is in, Bava with this very green meme. But more importantly, there's this tweet that says Jack Ma bought $50 million worth of Alibaba stock in Q4 according to the New York Times. And coincidentally, right, Adam Khoo also tweeted the same thing. If you guys don't know who Adam Khoo is, he's one of the biggest finance YouTuber I think in Singapore. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. And this goes in line with the trading methodology which I mostly prefer. I don't really like simple moving averages. I mostly look at volume. For those of you guys who don't know what volume price analysis, I'll really recommend you check this out. But a long story short, right, movement of a stock is influenced by volume. If you can see these volume bars over here, we need to always consider, right, that majority of this volume are not retail investors. This goes to another question: what percentage of trades are retailers? Only about 22% of users here are retailers, which means that up to 100% minus 22%, which is about 78% of trades here, are all by hedge funds or ultra rich people. So not everyone can go into the stock market and suddenly buy 50 million worth of Alibaba stock. So if you can see here, right, it's quite clear that the volume of transactions of the share have increased quite drastically when Alibaba had fell to low since 2022 February. If you can see, the volume here is extended. Every time the stock price of Alibaba goes to low levels, there is always a spike in volume. And the question is, who contributes to this volume? This will be hedge funds and institutions, or even maybe Jack Ma. If I were to zoom in into the week of 14 March 2022, there is a big ass spike. If you can look at the top left hand corner, 480 million shares traded on Alibaba. And you can see here recently there is many spikes, right? Based on volume price analysis, they would describe this as an accumulation phase whereby hedge funds are loading up on Alibaba stocks so that when the stock price increases, they'll then dump it to make sure that they earn a profit accordingly. How can you potentially profit from this movement? The first way to profit potentially from this is just buy shares directly on Interactive Brokers. I won't be demonstrating it because I think it's very basic, but if you want a video on how to buy a stock on Interactive Brokers, leave it in the video description. The second way to potentially earn some cash out of it is to sell cash secured puts. If you don't know what a cash secured put option is, when you sell one contract of a cash secured put option with an expiration of 30 days, for example, that means you promise to buy 100 Alibaba shares at $69.69 each. So when you multiply $69.69 times 100, that will be $6,969. If you can see here for Chicken Genius, right, he said he bought 100k of Alibaba at $69.69, right? So if he uses $100,000 divided by 6969, that means he's trading about 14 contracts of a cash secured put option. And if you trade 14 shares of a cash secured put option, let's see how much you can potentially earn. So let me type in the stock over here. It's slightly more tedious to use Trader Workstation, but I think most people should use it, and it's a preference of how I would trade most of my stock. Click on Baba, click on about 33 days to expiration. If you have 100k, right, you can click sell over here. Make sure it's a put option at $69. Unfortunately, you can't buy it at $69.69, but if you want to closely follow what Chicken Genius does, right, you can then click here 14. When you trade 14 contracts of a cash secured put option, right, you must make sure you have 6969 times 14. You must have $97,000, $566 to prepare to buy 1,400 Alibaba shares. So if you do that, let's click on how much you can potentially earn. Based on this profile, you can immediately collect $1,946. And because this option will expire on March 1st, there can only be two things that happen. By March 1st, if the price of Alibaba is above $69, you get to keep $1,946 for yourself. That's cold hard cash that you collected when you make the trade. But if the stock price goes below $69, then you'd have to spend $97,000, $566 to buy 1,400 Alibaba shares. Going back to Interactive Brokers, if you're okay with making this trade, you can click submit order, and then you'll be able to see the commissions and the total amount that you'll collect. So in this case, I'll collect a total of $2,000 $2,090. I'll really recommend you to make this trade during live market hours. If you just make a trade like that, there is a chance that your trade won't be filled. The next way to potentially profit from an increase in price in Alibaba is a bull put spread. If you're unsure, I've made a previous video demonstrating a bull put spread. I'll really recommend this platform called optionsalpha.com. They have provided very good resources all for free, and I'll recommend you check their website out. I've also made another video demonstrating bull put spreads in a lot more greater detail, but in this case, I'll also demonstrate it on Alibaba on Interactive Brokers right now. As a very quick recap, a bull put credit spread on Alibaba might look like this. You sell a put option at $69 and then you buy a put option at a strike price lower than the strike price you sold for your put option. In this case, I've demonstrated selling a put option at $69 and I've chosen to buy a put at $64 over here. So let's see how it looks like on Interactive Brokers. So firstly, I'll sell a put option. I'll then scroll down to $64. Usually, I'll be comfortable with choosing a date to expiration about 30 to 40 days for credit spreads. If I scroll down, let me scroll it to $69 and then I'll scroll it to $64. Make sure you buy a put option. So in this case, it will show you a bull put setting over here, which means you have selected the correct setting. Let me just demonstrate this for one contract. Click on profile. For every contract you trade this on, you earn a maximum of $86 and you might potentially lose $411. I'll recommend you to click the performance graph to understand the relationship between profit, to understand where the stock needs to be for your trade to be profitable. How I like to do this is to see the halfway point of this option. If today's date is on the 28th of January, I'll plus 28 days and it should be around February 24th to February 25th. So once I click on February 25th, I'll see what price Alibaba must be at for my trade to be profitable. So in this case, if I have to go along this line and look at the P&L, I need the stock price of Alibaba to be at least $68 for me to be profitable. If in this case, if the stock price of Alibaba is at $75.11, my profits will be at $56. The next question is, do I let my credit spreads expire worthless? The answer to that is not really. Usually I'll close a credit spread when it is at about 50 to 70% profitable. So in this case, if this trade is at least $43 profitable, I would actually close the trade. I will say that this is not my preference when it comes to trading credit spreads, because sometimes the implied volatility is not attractive enough for me to trade a credit spread on. Usually I like it to be above 40 or 45. Another thing I'd like to add is that the further the credit spread is away from the strike price at which you sell the put option, the more dangerous it is, and the max loss will definitely be a lot higher. I'll really recommend you to watch the separate video I've made for bull put credit spreads, which I've elaborated more in detail. Now, the positive thing about the two strategies I've shared with you for cash secured put and bull put credit spreads, time is your friend. If time passes and the stock price remains above $69, that means you'll definitely profit. But the potential downside of the strategy is quite a lot. For a cash secured put option, if the stock price of Alibaba goes to zero and you sold a cash secured put option, that means you have to buy Alibaba at the strike price at which you have sold the put option on. If it's $69, for every contract, you need to buy 100 shares. If it goes to zero, you can potentially lose all your money. But of course, it will take a lot for Alibaba to go to zero. The dangerous thing about credit spreads, if you don't manage it, you can potentially lose 5 times the money. So what I usually like to do for a quick calculation is to see the ratio of earning money relative to the risk. You'll take 411 divided by $86, which is about $4.70. So for every dollar that you're risking to earn, you're potentially risking $4.77. But then again, as I've elaborated in my bull put credit spread video, it doesn't make sense to hold a losing trade all the way to expiration. So you'd usually want to close the trade out if it's going against your position. The next strategy to potentially employ is to buy a call option. I've made another video on the basics of call option and I'll really recommend you to watch this video. Long story short, when you're buying a call option, you're anticipating that the stock price will increase over the long term. Let's say I buy a call option for maybe about 82 days. My preference when it comes to buying call options is when implied volatility is low, and I'll usually choose a date to expiration which is fairly long, maybe about 60 to 80 days or so. The biggest downside of buying a call option is that you have to pay money first. So when you buy a call option here, it might cost up to $800 to just buy the call option, and that is actually the primary reason why the break-even price of Alibaba will need to be a lot higher to make up for the fee that you paid for the call option for. I know I'm doing a very brief explanation of the call option, but I'll really recommend you visiting this website from Options Alpha to learn. To break even for this trade, you need it to be at $78.25. I'll recommend you going through the math and understanding why is it $78. If you trade one contract of a call option at $70, it gives you the right to buy 100 Alibaba shares at $70. But you only break even at $78.25 because you need to pay $815 upfront first for the right to buy Alibaba at $70. And that is the reason why Alibaba would have to increase from a price of $70 to $78, because if you do the math, 100 Alibaba shares at $70 is $7,000. So you take $7,000 plus the fee you paid for the call option, which is $815. So $7,000 plus $815, and that will be about $7,800, which is close to the break-even price over here, which is $78.25. If Alibaba does not increase in price sufficiently, which is not at least $78, you'll lose more money because the price of Alibaba did not increase enough for you to break even. So if you do this, you want Alibaba to be higher than $78. Now, the last strategy you can potentially use is called the bull call debit spread option. I will first disclaim here that I've actually never made a bull call debit spread option, but you can practice it in theory on paper just to understand how it works. But essentially, you're buying a call option and selling a call option. So the major benefit of this strategy is that you don't have to pay so much money upfront for the call option. I've set to sell a call option at $90 and I've set to buy a call option at $69. Unfortunately, I can't choose $69, so I'll choose $70 for now. I'll buy a call option. The most important thing for a bull call debit spread is to have a price target of which you want to exit at. Let's say you think Alibaba will increase to about $90 because you think that is a major support and resistance. So I'll go to Interactive Brokers, go to $90, and I'll sell a call option, and you can then see a bull call title over here. The next thing you want to definitely do is see the performance graph of it to see how much you can potentially earn and how much you can potentially lose. The first thing you want to take note of is the break-even price. You'll realize that the break-even price is slightly lower at $76. The reason why is that when you sell a call option, you're collecting money to offset some of the cost to buy the call option over here. I'll likely make another video on the bull call debit spread option in more details, but I'll really recommend you to read this article from Options Alpha if you ever want to potentially try it. I'll really recommend anyone to test new strategies on paper money. Even myself, I'm at a stage where I'm just learning all these new strategies. The one thing I've learned about trading options, at least in the past 2 years, is that there's so many option strategies, but it is actually not necessary to know all of them. You just need to choose the ones that are comfortable to you, that you are familiar with. At the end of the day, the stock can only go up, down, or sideways, but I think the easiest thing to do if you just want to follow Chicken Genius a little bit is to actually just buy the stock directly. It's a bit ironic because I'm mostly an options trader as well, and I'm just covering some thought process in terms of immediate things you can do. I'm all about learning along the way. The best way to learn is teach, and actually this is what I'm mostly focusing on. I hope this video is somehow helpful. Do watch some of my other videos on selling covered calls, selling bull put spreads, and I'll see you in the next one.